Venezuela is an ultimate oil paradox. China accounted for more than 50% of Venezuela's crude oil exports. India imported about 108 million barrels of Venezuelan crude oil in 2019. Why the US has taken over the Venezuelan oil reserves? When US forces seized Venezuelan President Nicolas Maduro in a rapid early January operations, many of the headlines followed and spoke about America's takeover of Venezuelan oil. But the real story isn't really about who owns the crude that's there in Venezuela, but it's more about how the oil can be extracted commercially above the ground. Venezuela is an ultimate oil paradox. It has gigantic reserves, chronically undersupplied and constrained supply mechanisms. And even with the political upheaval that has happened recently, that the geology and the sort of usability and feasibility of that oil is still questionable. So today we'll look at why the US has taken over the Venezuelan oil reserves, what it means for the overall oil markets, and its impact on the Indian markets as well. So the US officials have currently described a framework in which Venezuelan crude sales and proceeds would be routed through US specifically controlled mechanisms, which allows opening and reopening of pathways for these oil refineries, crude oil, etc. Not just for the American markets, but even for other global players as well who are working or have access to work in Venezuelans' oil fields. Now, in oil, when we speak about all of this, there is a choke point. A country can have vast reserves, but it can still be commercially isolated if four things happen. One, buyers can't pay without triggering sanctions exposure, which was the case historically with Venezuela. Two, insurers may not cover the cargo that's happening. Three, ship owners fear seizures or blacklisting from various governments, such as the US government, for instance. And four, if oil field services firms can't deploy their equipment and staff without any major legal risk. Now, as you can see in this graph, for the past few years, Venezuela has shown its oil supply has been constrained by the lack of demand. It's constrained because of the lack of permissions, lack of capability, and the severe sanctions that the US and many of the world countries had put on Venezuela. Now, when we look at Venezuela's oil reserves, it's nearly about 303 billion barrels of proven reserves are there, which is one of the largest in the world. Yet, when you look at how much it's producing, it's significantly short of its capacity. Years of underinvestment, operational decay, technical issues of heavy crude, multiple sanctions have left production of oil hovering at just barely 1 million barrels per day, which is far below its historical peaks. So that's why the markets are currently treating this current event that has happened as an inflection point for our expectations, more than an immediate physical supply shock that could impact oil globally. Even in the most bullish of scenarios, there is a lot of emphasis that's being placed on the time that is needed and the capital that is needed to really bring oil to the market. Restoring and expanding Venezuelan oil output requires significant field rehabilitation, upgrading logistics, power reliability, a stable operating environment, a stable government within the Venezuelan country as well, none of which are going to be fixed by a single weekend of US's invasion into Venezuela. If there's any immediate trade flow impact, specifically for oil imports, that will happen largely for China, and that is for China's independent refiners. In recent years, Chinese refiners had become one of the most dominant outlets for Venezuelans' oil output. And these were especially refiners that were specializing in buying sanctioned barrels in very deep discounts. China accounted for more than 50% of Venezuela's crude oil exports, and a meaningful portion of that flow has been tied up in debt repayment structures that don't look like normal sort of market trade routes. Following the US action and the emerging oil export framework being set up by the US, traders are expecting these Chinese refiners to replace the Venezuelan barrels with Iranian and Russian barrels, which are also under sanctions, because the real key attraction for these Chinese refiners was the heavy discount that they were getting the oil at. Now, when you remove the sanctions risk and you remove that discount, You're disrupting the logistics, you're forcing companies and refineries and countries to find substitutes. From the US's perspective, this is very strategic. It has an impact on China, so that's a good thing from them and from the trade war perspective. When we look at Venezuela from the US's perspective, it has heavy crude, which is geographically and technically better suited for the US Gulf compared to long voyages that were happening to China or other parts of Asia. The proximity of Venezuela to US also means that lower costs of freight, transportation is easier. It makes it also easier for them to comply and ensure all the norms and procedures that the US is setting up are being supervised and the sales are being supervised as well. When you look at the historical numbers, the US's dependence on oil from Venezuela was one of the highest way back in 2016 prior to the sanctions. Now, if Venezuela is sitting on so much capacity of oil, what exactly is there really a refining problem? Well, from India's perspective, yes. Venezuela's flagship reserves are essentially what India has bought historically have been Mary, which is typically a very heavy, high sulfur oil barrels. Now, processing them requires a lot of efficiency. It requires very complex refineries with the right amount of technology and capability to do that. And in the Indian context, there's very few assets or refiners that can do this at scale. Probably one of the most notable ones is Reliance's Jamnagar complex and maybe Nayara's Vadinar refinery, because they're both designed for this heavy, high sulfur crudes. Now, if Venezuelan barrels return, the upsides are concentrated for these refiners who can monetize this heavy crude, improving potentially their margins and procurement optionality rather than lowering costs for all the refiners across India. So where does India fit? India's near-term oil balance doesn't automatically swing just because Venezuela's political order has shifted and Venezuelan crude has now become accessible to the market. It is still a very small slice of India's import basket if you look at the numbers. India imported about 108 million barrels of Venezuelan crude oil in 2019, but when you look at the flows over the last 4-5 years, that dropped to about 25 billion barrels in 2024 and nearly just 1 million barrel in 2025. So much of the damage to India's Venezuela link happened much earlier because of the sanctions and the trade risk, etc. Now when you look at Indian officials, they're echoing similar sentiment that the immediate impact on India is likely to be limited and constrained because Venezuela's share is still marginal at best in the short run. But limited near-term impact isn't the same as it being irrelevant. India still has 3 meaningful exposure channels to the Venezuelan oil markets. One is by improving the refining opportunity through taking heavily discounted heavy crude reserves. Second is an upstream recovery where Indian companies who have receivables stuck in Venezuela can sort of start getting those out. Third, there is obviously geopolitical leverage. US controls the Venezuelan market effectively, and how that trade policy works with the US is something that India needs to look at. So the most important India-facing lever is not really the number of barrels that Venezuela can pump next month, but it's the sanctions that are still involved. Historically, when you look at it, Indian companies have operated under that reality. Reliance did get approval from the US markets, from the US government to import Venezuelan oil in 2024. And the US has shown that it can apply this economic pressure through trade policy to alter oil purchasing behavior. Now, Reliance planned to stop buying Venezuelan crude oil after the US policy threatened tariffs on countries that were still purchasing Venezuelan oil, which effectively means you can quickly go from having these cheap barrels which become very quickly expensive for the country. Now in the Indian context, specifically in 2025 and in 2026, India is also navigating the US pressure that's there around crude flows that is coming in from Russian oil, for instance, along with other trade issues that India and US are still negotiating. So there is a lot that's still at stake when we look at it from India's perspective. So the real drivers over the next 2 years are these three. First is there needs to be policy clarity. Whether the US control becomes environment of stable sanctions, where there is licensing frameworks accessible to not just US companies but other broader companies as well, is something that we'll have to watch over the next 2 to 3 years. And the second is that there is an operational recovery here. Venezuelan output cannot really rebound fast. Restoring production will take years of and billions of investment, and will require infrastructure upgrades, not just at the refinery, but maybe from a logistics and transportation perspective as well. Third is also India's ability to use it. Venezuelan crude can be around 14 to 20 billion barrels cheaper, but only a few of those Indian refineries can really process this heavy grade at scale without blending and configuring their sort of bottlenecks too much. If those refiners expand capacity, then India gains more cost and geographical flexibility. If not, then Venezuelan crude effectively has very limited impact on India in an isolated capacity. We hope you enjoyed this video today on what's happening around the world in terms of Venezuela, US, and the Indian oil markets. If you want us to cover anything else next, do let us know. Happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.